Hi everybody, welcome to Talking Automotive with Mark and John. My name is John Sinclair and my co-host Mark Palavestra.
Hi John, today we're going to cover off our forecast for the industry for 2021 on the back of some pretty strong indicators and a very strong end of the year with November and December being up year on year versus 2019, which are some pretty positive signs, and there's a lot of momentum going into this year. That's very good.
With 30 years' experience in auto logistics and state-of-the-art locations in 5 major Australian cities, Precar Fleet Services is an independent division of Precar Services, offering specialty fleet fit-outs for commercial applications ranging from simple tray and tow bar fitments to fully bespoke service body and accessory installation. With quality-assured safety, compliance and standardisation of vehicle builds, Precar Fleet Services are a premier all-in-one solutions provider for commercial vehicle fleet operators, leasing companies, and original equipment manufacturers. For further information on how Precar Fleet Services can assist in solving your commercial vehicle fit-out needs, please visit precar.com.au and click on the link to Fleet Services.
Yeah, Mark, 2020 was a bit of a wobbly year. We had so many things come in and impact it, and the rules changing all the time. There was lockdown, there was open, there was a lockdown again. So all of these factors having a great impact on the market. But I think the market was fairly resilient, even though it was a pretty tough year. So what's your predictions for this coming year?
All things being equal, where we don't have another severe lockdown like we had in Victoria, and we have similar situations where if there is an outbreak, they're handled quickly and the shutdowns are minimal from a disruption perspective. But overseas travel won't be a big thing. So what I predict is a return to the pre-COVID volumes on the back of some significant stimulus that's out there. So when we look at the market was a 1.1 million car market tracking along consistently for a number of years. And then we saw the market starting to decline in 2018 and 2019. Now, that's on the back of a correlation between a drop in the Australian dollar and an introduction of tighter lending rules with APRA lending. We also saw a slowdown in the real estate market. And as we know from the dollars and the data presentation that we had with Potentiate and Ben Sullivan, the age group that buy cars are primarily in that 40 to 60 age group bracket. And that age group really take advantage of the wealth effect with real estate. So when you look at why we're going to have a stronger rebound, we've got an easing of credit. And Philip Manton, his presentation to us, talked about the challenges in getting people finance set. From a private perspective, that's not going to be a problem. In fact, it's going to be the opposite. There's going to be more money being lent. And we're seeing that already in the November and soon to be released December numbers, where lending for houses has actually increased, and particularly existing houses. As long as there's effective COVID pandemic management where we don't have lockdowns, the stimulus packages will continue to at least midway through the year. We have record low interest rates, and they will continue all the way through this year into next, so giving people a lot of confidence to borrow more money, and an easing of the credit rule so that you can actually access that money. So the APRA changes will take effect. And don't forget, the biggest thing that really impacts vehicle purchases and affordability is that improving Australian dollar, which means there isn't going to be significant pressure on prices to go up, even though they actually have gone up because of tight supply. But we'll see supply will return in the quarters 2, 3 and 4 this year. Q1 will be a little bit tight from a supply perspective, but supply will ramp up and we will see that recovery on the back of that. So from a forecast perspective, 916,000 was the number last year. When we look at it from a month by month and just looking at where the gaps were last year versus this year in the segments, there is a potential to get to 1,112,000 units this year. And that's on the back of 100,000 gap due to vehicle shortages in volume in 2020 versus catch-up. And if you look at it, just the rental market alone, we spoke with Steve Short earlier in our presentations, and the rental market was down 39,000 vehicles. Rental market relies on aeroplanes. Now, there won't be overseas people coming in, but there's going to be more domestic travel. As the borders open up, more domestic travel, which means there will be a demand for those renter cars. And we already saw it where people couldn't go to Tasmania because there were no cars to drive. Or if you went to regional locations, there were no cars to drive. So there's 40,000 units alone just in the rent-a-car market that have to recover to get those fleets back to normal, and also have updated cars. The other segment that was down year on year is the business and government. And this is another one of our presentations where the feedback we got was that a lot of leases were being extended by an extra year. So those vehicles need to be defleeted, which means there's a good opportunity for those to come back into the used car market because they didn't come in this year. And that means there's 74,000 cars that need to be replaced, more so than previous years. Those 74,000 plus the 39,000 renter cars on top of the stimulus package is easily going to be another 100,000 cars for this market. The exchange rate will stay attractive, which means the OEMs will definitely be bringing product in here because it's a profit opportunity. If you are an importer, you're going to have a good profit opportunity to make some money in a market that's going to be buoyant and resilient because of the COVID management, etc. And just a little bit of a tidbit for you, John, a bit of interesting information. If you look at the Australian total car park of cars, the car population is 19.8 million cars. And it's pretty steady around that figure. It sort of fluctuates within 100,000 cars year on year. And around about 760,000 cars leave the road each year. So when you're putting a million cars in, there's a net increase of a couple of 100,000 a year. But that will be an interesting stat to see whether that changes or not. Because even though there's 19.8 million cars on the road, there's actually 19.8 million drivers or people of driving age. So it's pretty much one car per person. And with this desire to avoid using public transport and have your own transportation, and even with this the tree change and sea change that's happening where people are moving out of the inner areas, you need to have a vehicle to move around. So this underpins that demand. So supply and demand will mean that volume will increase. The manufacturers will match that supply or match that demand with increased supply, which means we get back to that 1.1 million car market.
Yeah, Mark, it's really interesting that putting a figure of 1.1 million, just rounded up, what you predicted there. So it's going to be a pretty strong year for dealers. So what would be your advice to dealers and OEMs going forward now? Should they be ordering a lot of stock, or how would you give them advice now for the coming year?
Well, OEMs will be ramping up production as it is. So the slingshot for the year will see most OEMs getting as much production in their international assembly plants in January, February and March. So the Europeans and the Americans are in disarray. So there's all sorts of challenges in those markets, but they will still be wanting to supply their own markets first. However, when there's a strong exchange rate in their favour with Australia, it makes sense for them to build more stock, and the bullish OEMs will be ramping up that supply. That in turn means that there's supply then for the dealers. The dealers are screaming for cars. They've all been caught short. They've run out of stock in December. December was bigger than most expected. To do a 95,000 vehicle month in December in a pandemic is a huge turnaround and an increase year on year. So supply will be out of balance, which means that there's going to be catch up. And that catch up won't really take effect until March. When we look at the March number last year was 81,000. That was artificially low because already the pandemic had hit. March is usually 100,000 cars, and I'm predicting will be 100,000 again this year as supply loosens up. The big increase will be LCVs. If you look at LCVs, in March last year was only 18,000 units. I'm predicting it's going to be a 24,000 unit March month because you've got all the Japanese brands that's their end of financial year. There'll be a big push on and there'll be supply. And then you look at May, there were only 14,000 LCVs sold in May last year. that is a 24,000 unit LCV month all day, every day, especially with the stimulus money that's out there. So 23,000 is a conservative number that I've got for that month, and a 34,000 unit June for LCVs. Last year was 28. So it's really not a hell of a lot of an increase if you look at it year on year. However, it's consistent and it makes sense. The one that was down big time is actually the passenger market, but we're actually seeing the private side of the passenger market was quite resilient. This is where these customers were going back to buying passenger cars, small passenger cars, for that commute to avoid that public transport. So there's still plenty of action, even though we're migrating to be an SUV market, like the US SUVs and LCVs. There still is a requirement for passenger cars. LCVs will still be the flavour of the month because they're going to be very strong from a instant asset write-off. But the luxury side car market, and that's where a lot of the passengers' luxury cars come into play, it will be strong as well because of instant asset write-off. And there's just been such a constrained supply.
So overall, Mark, is going to look pretty positive for dealers and OEMs for this coming year. I think profitability should be good because they've still cut costs from last year. So I don't think they'll ramp up the cost side of the business that quickly. So with the volume coming back, with reasonable demand, and with their cost structures at the right position, dealers and OEMs should be in a good position to make a relatively decent profit in the coming year. What's your view on that?
Oh, it's going to be a great year for everyone involved with the auto industry. The real estate market's going to be strong. The real estate market will flow into, there'll be good money for banks and lenders. There'll be good money for dealers and OEMs because there'll be supply and there'll be volume. And with volume, with good margins still, and also good demand for used cars. So that used car market is still going to need stock because it was constrained for stock pretty much for most of last year. So there's still going to be a demand for that used car stock. So there's actually going to be an upside even for fleets and leasing companies where your residual values will still be quite high. So they'll be getting some good volume out of and good margins out of that. Ultimately, it's got to be paid for. The people who will pay for it are the consumers, and there'll be plenty of access to credit to do so, because the other thing that's been a significant change versus the last 3 years is that with the no overseas travel and the constrained movements, people have actually saved a lot of money. So household savings are at record highs. So what are you going to spend your money on? You can only spend so much at Bunnings renovating the house and fixing bits and pieces up. You're not spending that $20,000 on an overseas trip, which is what the average family would be spending. And if you're a double income, no kids, at that younger end of the market, there's 10 grand at least that you've saved without doing an overseas trip. So that money is getting put into cars. And we're even seeing this with the accessory market with tow bars and roof racks. One of the hottest items right now over the summer period has been the demand for roof pods for that extra storage when you go away on holidays. So roof racks, huge demand, and any accessory associated with that, along with the toys that go with them, whether they be boats, caravans, or Sea-Doos. The demand for those has been very good. So it's all about that lifestyle, but keeping that money here. So the 25 million Australians that live on this island are going to move around, and they're going to do it with mobility that they're spending here.
Thanks everybody for listening. Mark's put together a great prediction for the year. It's going to be interesting to see how it pans out. Naturally, we'll review this in coming months and update according to changes that happen in the market. But it's looking pretty positive for a good year, and we're looking forward to a good one. Happy New Year, and may this be a great year for you and your families. If you enjoyed listening to us today, please tick the bell below or like us on LinkedIn. If there's anything you'd like us to cover in future, please reach out to Mark Palavestra or myself, John Sinclair, on LinkedIn, and we're happy to provide support or cover any topics you'd like to hear about in the future. Thanks very much, and we will chat to you again next week.